Number one, core assets have to exist within cities that are viewed as institutional and provide a broad group of buyers and sellers at all times. So if you see a brand new building with a long-term credit tenant that's in a very, very small city, maybe it's a city of 200,000 people or less, that is not a core asset. Now, once you get the city selection, you move on to the submarket selection. And I'll give you the example of Chicago here because it really is a wonderful example of how a city can be viewed as institutional and a place for core assets, but you really have to break it down much further into submarkets. So there are large areas of Chicago that absolutely are not an area that a core asset could be, even though the city as a whole is a city that certainly is a place where institutions invest. If you're talking about downtown Chicago, the Loop, or the West Loop, or River North, or Lincoln Park, or some of the higher end suburbs, the 290 corridor, or up into the North Shore, these are areas that would absolutely be institutional and core assets can't exist. However, if you're talking about the far west side, the far south side, still in Chicago, but absolutely not a place that would provide liquidity on exit, so it doesn't check the box in terms of location. Now we'll talk about vintage in core assets. So what I'm saying when I say vintage is generally a core buyer wants an asset that isn't going to be very difficult to maintain. And so they're looking at it much more in terms of a cash flow stream and less as, well, I need to make sure that the roof is not leaking, make sure that there's enough capital. And newer assets tend to mitigate that. And obviously the older an asset gets, the more maintenance it's going to require an investment of capital. So from there, we're looking at the cash flow of an asset. In core assets, the investor essentially is buying that income stream. A core building is all about the dividends it produces today and then inflationary growth or the growth of those earnings over time. And an analogy to that would be any dividend paying stock. For example, a mature company like Coca-Cola. They've been around for 100 years. They really don't have amazing growth prospects. You could argue they've saturated a lot of the world in terms of their products. But what they are is a market leader that produces a dividend, and i.e. that's a dividend stock, or I would almost call it a core stock if it was a private real estate asset. From there, the frame moves on to debt to equity. You can be all those things and still not be core simply because of the debt to equity ratio. And so core assets pair low risk, predictable income stream, high quality liquid markets with low debt levels. And those low debt levels generally tend to be between 40 to 45% for core, meaning you're going to have 50 to 55% equity paired with 40 to 45% debt. And again, that leaves the asset in a very safe place because if there's a market correction or any disruption of cash flow, you have so much equity in the deal that you're never really going to be at risk of losing the asset itself. So we've talked about the characteristics of an asset to be considered a core asset. Now let's move to the expected returns an investor should receive for purchasing that core asset. Generally, the market has seen pressure on all expected returns. And so this has been something that's been happening for the last 24 months. And you see it certainly in the debt spreads. We used to have to borrow at 300 or 400 over LIBOR, which is the riskless rate. Those spreads have really gone down all the way from 200 to 275. So you're talking about almost a 30 to 40% move in those spreads. And that's the return banks are willing to accept for a loan at a constant unit of risk. If you speak to any of the large advisory shops, recently JP Morgan and Vanguard both came out and said, we believe that the expected value on stocks, U.S. stocks for the next 10 years is 4 to 6%. Now, historically, they've been anywhere from 8 to 9%. So that's a massive move too. You're talking about 25 to 30%. Real estate's seen the same, I would say a little bit less, but we have seen it. And that's something that you need to be aware of because if you're speaking to a manager who is offering a core asset at a return level much higher than that, I would suggest that you really need to do your homework on the manager or the investment, because it could be there are risks that you're not aware of. There's generally no free lunch in investing, and if you see a core asset that could get an 8% or a 9% return, maybe that's possible. But if you see something higher than that, there's probably a red flag that you need to do a little bit more work on to figure out why it's such a high return relative to that asset class. It could be that it's in a smaller market, and so there's liquidity risk you're taking. It could be that it's in an up-and-coming submarket, and so there's market risk that it won't gentrify, and there's liquidity risk. It could be that they're taking more debt-to-equity risk than you think, and you have to go down to the asset level to see that. Are they borrowing 60%, 70% for the bank? Because they really shouldn't be borrowing more than 40%. So who would want to invest in core real estate? I would simply say anybody who's viewing their public stock portfolio as a dividend stock portfolio, that's reflective on you and your view of how much wealth do I want to protect versus place at risk, and how much am I willing to take in terms of a return. Because back to the Coca-Cola example, if you buy Coca-Cola stock and you're buying that dividend because you want that constant dividend stream, the opportunity cost is you're not going to have the upside tail as if you invested in Amazon, right? Amazon is reinvesting earnings constantly. They're not giving you a dividend because they think that they can build a company that's bigger and bigger and bigger, and you as a stockholder share in that growth. That's what a growth stock feels like. But there's also risk to that growth, right? So when you're not getting a dividend, I would say the distribution around your return is much, much larger. But the flip side is, don't buy Coca-Cola and expect in 5 years that you quadrupled your money. That's not realistic, right? So if you're an investor that values dividends, or in that part of your portfolio values dividends, a substitute good would be a core asset. It'll be low leverage, constant, predictable dividends, and so it's a substitute good.